Oh my lord. Hi, this is Sam Orgill, ProACT Partnership. Welcome to this live Living and Working Abroad webinar. As you can see, we're in full-on landscape today. I hadn't anticipated that, and we've got it all set up to do a portrait event, and we haven't got that anymore. So forgive me while I'm just trying to adjust to fit in with what we're doing. What we want to do today is look at a preview of the budget. It's more than 2 months away in the UK, but it gives you time to plan ahead if you're an expat living and working abroad, or if you've got UK assets or you're an expat in the UK. So what we want to do is look ahead with some 2025 UK budget predictions. The budget has been delayed by the government because they have to go through, allegedly, their extended discussion process with the budgetary office to make sure that they meet their uh, budget and spending requirements. Now, this is an important thing for uh, a government to do, especially when they've set their own criteria to meet the objectives within that period of time. Um, There could be other reasons for delaying it to the bitter end of the year, just as people are getting into the Christmas season, or to align it with the start of the calendar year. Either way, what we know is that the budget needs, on current forecasts, to raise between 20 and 30 billion pounds. The first Labour budget in November 24 raised nearly 40 billion pounds. So it's got to be something of that magnitude. Now, you don't have to raise taxes, you could cut spending. But we've seen already with this government, they tried to put through some spending cuts and actually wasn't allowed by the party. So, as we always say, in a democracy, everything moves back to the centre. We had a default election with a far left government elected, which is trying to implement its policies. And that is coming unravelled as everybody wants to move back to the centre ground, away from a far left basis of the current government. So they're being held to account. It's irrespective of you've got a big majority. Rebels will form within that because they know that they can rebel without bringing the government down, without losing their job, but do enough to cause ructions. And like we've seen with ministers, it's almost one a week at the moment leaving place. We'll see who's going to be next time. So uh, we're looking forward to this budget, 26th of November. Now, who will who will the British government blame? What we found the first time was that they'd like to blame the previous British government, the Tory government, for bad planning and for hidden expenses, and that's why they had to put up taxes. 18 months down the line, they can't really blame anybody else. They've had plenty of time and the majority to take action to get it sorted out. So they could try and blame the previous British governments. In effect, all British governments over the last 25 years have followed the same policy. Or they could just say again, like Tutira said this week, I don't know. I didn't know when I said that. So there might be somebody to blame, who can say? But it is what it is in terms of the budget's going to come up. We know what they need to raise. They may make some changes, they may not. If you're an expat living and working abroad in the UK or outside the UK, if you make plans now, got a couple of months where you could implement the changes and take some action. It might not work, or it might work. We don't know. But if you have something to do with your wealth, to do with your property, your pensions, your land, your income, your business, something you want to consider making some adjustment because you've already got overseas property, or you've got interests abroad, or your property is cross-border. There's potentially something you can do now to change the name and the potential tax liability. Don't forget, when you have a budget announcement, the government can make it law from midnight on the night of the budget. So after the 26th of November, we'll know what the new rules are. Some will come in on the following start of the new tax year. Some will come in on the 26th of November. Uh, for more help and guidance, contact us at ProACTPartnership.com, and we'll be able to offer you a free review to discuss how you could adjust your business, your property, your investments, your pension or your land to protect it from additional tax. Because as we'll discuss a bit more next week, who will inherit your wealth when you die? It'll be the tax man. Who are you going to pay your tax to next year? How much you're going to keep for yourself? The biggest talk is about a wealth tax. Now, what is a wealth tax? A wealth tax could be anything. There are some countries that do have a wealth tax, or they just do have a flat rate tax. In the UK, the tax system tends to accumulate everything into a highest marginal rate of income, corporation, or capital gains tax. Okay, but not all countries work like that. Some have a flat rate tax as well. So if you've got VAT to pay, it's VAT on the sales. It's a flat rate tax, that 19-20%. So flat rate taxes do exist. They're not generally very productive, but they do work. Sometimes they're called a solidarity tax, sometimes they're called a health tax, sometimes they're just called a wealth tax. But you can have this flat rate tax on everything. What the PR playbook will do is say that there's a minimum limit, so it's protecting working people, it's protecting people on low incomes, or pensioners, or whatever they want to say or adapt it to. But at some point, people with property or investments or businesses or any type of wealth inherited is going to breach a threshold and be liable to pay a tax. Now, paying tax is not a bad thing, but what we're talking about is change, and the change to your life savings, your wealth, and how much tax you pay in the future. So what you do now in your tax planning is legal and is allowed, and you can do it um, to plan ahead and get and save that tax going forward. If you do nothing during your lifetime, if you don't write a will, if you don't make a family trust, if you don't make provisions for your affairs, and you die intestate without a will, then you've got the cost and delay of probate to the nth degree. If there's no will, it takes longer. You have to do the searches of people and events, and you've got the expense of employing professional people to support you in doing that. By using trusts, family trusts for your business, property, and land wealth, you can protect your capital from the cost of delay and probate, but also potentially be gifting it in anticipation of saving capital gains tax in inheritance taxes. There's a footnote in this presentation. A capital gains tax is charged during your lifetime. Inheritance tax is a capital gains tax that's charged on death. So at the moment, capital gains tax doesn't apply on death because you're going to get inheritance tax. That could change. There's no notion that it would do, but just bear that in mind as well. So if you sell a commercial property after you're dead and you've got an inheritance tax assessment on the estate, capital gains wouldn't necessarily apply because inheritance tax would. It's not taxed twice, taxed once, but at what rate? Capital gains tax rate or inheritance tax rate, 24 or 40. For more information and guidance, contact us at ProACTPartnership.com. So let's have a look at the different types of accumulated wealth that could get taxed. Property is an easy one. A simple revaluation of assets for tax purposes by a government can yield additional higher rates and stamp duties and taxes going forward. So that would be a simple thing to introduce, to announce, oh, we need to update from 1991 the property values and unregistered as a tax basis, and that would then generate them taxes going forward. Um, the bearing in mind to balance the budget, as long as the projected revenues going forward works for the government, works for the Office of Budget Responsibility, then it's going to work. So it's not necessarily going to take money out of your pocket today. It's just that when people buy, sell, live, die, or move property or wealth in the future, they're going to pay some extra tax, and that potential tax revenue the government borrows against on gilts. So revaluation of property values is a very simple way of locking in future additional tax revenues on stamp duties, capital gains taxes, or council taxes. We've already seen that to a degree, in that it's a very confusing situation where some councils have got the potential to tax second properties with double the rate of the council tax. So if they deem that an expat has got a holiday home in the UK, or that they're living abroad and their main property in the UK is empty, they could deem that to be double the council tax rate. A very confusing situation at the moment. That could easily be made a mandatory type of law. However, uh, why not simplify it all? Instead of having council taxes and stamp duties and revaluing the assets, why not revalue the assets and introduce a new property tax, a flat rate tax that everybody with property owns in the UK, commercial or residential, pays at an annual rate. So instead of rates, we'll abolish rates, which sounds good, it's a tax saving. We'll abolish stamp duties when you're buying and selling property, a tax saving, but then you introduce an additional flat rate tax. So if you've got a property worth £1 million and you introduce a tax of 10%, uh, you know, that's a flat rate tax. If you introduce a tax of 1% on £100, it's £1. On 1,000, it's £10. On 100,000, it's £100. On a million, it's even more. So just bear in mind what that is. The rate could sound very low, but it could still be real money to you in terms of how much you're going to pay in terms of a flat rate property tax you can be paying on your estate. For more information guidance on that, um, on protecting your property from future taxes, contact us at proactpartnership.com. Properties are very much a fixed asset. That properties have their own tax identity, their tax number. This is why you pay stamp duty and capital gains tax when they're sold. The taxable entity is the property that generates that liability. When you rent the property, that property rental tax is fixed in the UK. It's fixed in the UK. So even if you go to live abroad, you're renting property as an expat, the income from that property rental is still taxed in the UK. At the moment, you could get a capital gains tax liability on a property sale. It's still fixed in the UK, so you have to pay that capital gains liability. Okay, so it's quite a big. The properties are quite fixed in the UK for what you're going to pay, especially residential property. At the moment, there's a principal private residence relief for people. Now that's for anybody that owns their own main family home in the UK. But again, what if you're an expat and they decide to remove it if you can't demonstrate that you're living there all the time, even if it's because you're spending 6 months in the Algarve or 6 months in Cyprus or 6 months in Spain, they may deem that the fact that anybody who is has the wealth to own two properties and spread their time between multiple homes, is deemed to be a suitable target for tax. So again, the wealth tax could be introduced not just in terms of a round number as a flat rate property tax, but also it could be used to penalise people that have got property portfolios, whether they're renting them out or whether they're just having them empty as a second home, as something of a tax on that, what is deemed to be a privilege for owning that additional property. So again, it's another consideration. Principal private residence relief could be under attack. It could be whittled down so that if you've got more than one home, uh, then principal private residence relief could be removed altogether. That would then leave you open to capital gains tax on all uh, residential property sales going forward. Could the current government go as far as that to make that judgment? It will be a big political gamble. It depends how far left they want to move. They've got the majority, they've got the political will to stay in power, then potentially they could do that. What you can do at the moment with property is you can gift the property uh, into a family trust and potentially be exempt from capital gains. Uh, More of that later on. When we talk about property, land is treated slightly differently. Commercial property is treated slightly differently. If a corporation, if you have a company that owns a property, the stamp duties and the potential taxes are different as well. So if you're renting a property at the moment, a residential property, renting any type of property as an individual, you've got your highest marginal income tax rate, 45% as your tax rate. If you rent it as a company, then your corporation tax rate applies. Now, at the moment, we've got corporation tax, which is 25%, but there's some relief down to 19% for lower, smaller businesses. So we could see that removed as well, so that everybody that's a company is going to pay 25% on their profits going forward. So it's not going to affect a business this year. It's going to affect a business going forward at everybody's year end going forward. It affects big business and small business going beyond. I don't think that corporation tax changes are potentially a big thing. I think it would be a massive, massive, massive political misjudgment when you look at some of the companies that are investing in the UK. They must be doing it with some type of promise or assurance that corporation tax rates are not going to be massively affected. So if you need more help and guidance, contact us at proactpartnership.com. So we talked about property in a number of different scopes of taxes that it can do. Now let's talk about pensions. We've already discussed in previous Living and Working Abroad shows how that um, the pensions, your fund, if it's a self-invested pension fund, is now subject to inheritance tax when you die. Before up until 2024, the last budget, you could uh, have a self-invested pension fund and give that all away to your family tax-free even after you died. The pension is held in a trust fund, but that was then now deemed to be a taxable pension fund at 40% when you die. Now you can draw that out during your lifetime and pay 45% income tax. What else can you do? Well, there is something you can do. At the moment, if you as an individual, as a beneficiary of your self-invested pension fund, live and work abroad, then potentially you can transfer your pension income to be taxed in your overseas location. And as we said before, if you choose a Cyprus location, your tax rate is 5% on that pension. So you can have £1 million pension and you can draw your tax and pay 5% on the whole fund, which is £50,000. That could be deemed to be quite attractive. If you have £1 million self-invested pension in the UK and you want to uh, uh, avoid inheritance tax of 40%, to draw that £1 million pension, you're going to pay 45% income tax for that year. So it's not a good plan. Um, relocate abroad, get your pension registered abroad in a low tax jurisdiction, you could pay as little as 5% or even better. And once your pension fund is outside um, the, the, the pension, you can then put it into your family trust and protect it from inheritance tax as well. So you can pay, say, 40% income tax, and then you can save 40% inheritance tax. For more ideas on taking your personal pension fund and drawing it down and save 40% income tax and 40% inheritance tax by living and working abroad, contact us at proactpartnership.com. It might be, though, that you don't need to live and work abroad. There is such a thing called a family trust. So if you've got investments or property or business shares that are held already, there's no reason why you can't hold a family trust in your name. And a jurisdiction like Cyprus is very effective for this, as is Jersey and Guernsey and the Isle of Man. Not under British tax jurisdiction, therefore have different sets of rules. In Cyprus, no inheritance tax, 0% capital gains tax, and zero dividend tax for expats over here. So you could gift your wealth, your shares, your family business, your investments into a family trust based in Cyprus with the support of ProACT Partnership. And then we can manage that for you um, with the family in control, avoiding the cost and delay of probate and saving 40% income tax and 40% inheritance tax on that fund indefinitely under the current regime. Tax laws might change in the future. Contact us today to discuss your options and availabilities at proactpartnership.com. Capital gains tax was increased by 80% in the 2024 budget, from 10 to 18%. The maximum rate of capital gains tax is now 24%. There's, again, a bit of confusion on capital gains taxes, different rates for personal uh, residential property and commercial property and other types of capital gains. Why not simplify that? Again, I don't know what they're thinking, or this is pure potential. But if you really wanted to hammer home capital gains tax as a lock-in potential tax income as a government going forward, which would please the budget Office of Budget Responsibility and allow you to borrow more on the gilt markets to keep spending and get through to the next election, then why not change capital gains tax quite radically? Capital gains tax didn't exist before the 1960s. It was introduced by the Harold Wilson government. It exists now and it's 18 or 24%. Why not allow it to income tax? Why not have 20 and 40% capital gains tax? So if you're deemed to be successful in your income and your wealth, why not pay a much higher capital gains tax rate as well? So it tax you when you earn the money, tax you when you cash in on the profits of your investment, as well as the dividends that you get. So it could be that we could see an alignment of income tax rates. So everything is 20 and 40% instead of the variable rates that we've got for dividends from 8% to 33 to 39. Why not see 40% and 20% dividend tax? Why not see 20 and 40% capital gains taxes that would give that alignment for that with deferred tax payments in the future for people, which would give the government the room and resources to keep spending in the way that it wants. For more help and guidance and information, contact us at proactpartnership.com. Gifting is still allowed. While you're abroad, without capital gains tax, gifting to family is still allowed. When you're abroad, if you realise an investment, a capital gains tax that's not fixed in the UK, i.e. residential property, is a deferred liability. So there's an anomaly there. So people that are expats to the UK, in terms of buying property and shares and investments, don't pay a capital gains tax if they're tax resident abroad when they realise those investments in the future. Um, why is that? Now, if you want to raise tax for the future, you could easily change that. And why not? Why give an expat the option to defer that tax liability for 5 years when they stay outside the UK, when you could in fact tax charge it on them now? So again, uh, a change. So instead of just residential property being the fixed capital gain in the UK, all capital gains are fixed and taxed in the UK with no deferment if you're an expat abroad. That could be a way of blocking the way of people relocating overseas and saving their tax. Uh, Again, we're speculating about the changes and the types of wealth taxes they could introduce. Discriminating against an expat who's not a British tax resident and not even necessarily a British voter today is a real way that allows the government to uh, uh, raise taxes from people that are not going to be voting for them in the next elections. So let's see if that attack on capital gains, that extension of capital gains to align it with income taxes is a possibility going forward. For more help and guidance, contact us at ProACTPartnership.com. Pensions. Everything that we said about property and pensions so far is valid. Um, what else can they do? Now, at the moment, you get tax relief when you put money into a pension, and that's been a contract for 30, 40, 50, whatever is your working life. However, there's no reason why that can't change. It's a bit callous for them to change it all at once, but why not make that pension fund more taxable? It was done in the 2024 budget by introducing inheritance tax onto that state. Um, but why not go the step further? If you've got a Canadian or USA pension and you want to uh, uh, go abroad to receive that income, that's not necessarily going to be an income tax free, that's not necessarily going to be released from your home country's tax regime. And if you've got a civil service pension in the UK, any sort of government service pension is still taxed in the UK as a fixed income. Inheritance tax is introduced onto all self-invested personal pensions in 2024. Why not go the next step and tie in uh, all pension incomes from all self-invested pension funds to the UK going into the future? This again would lock in everybody's self-invested pension into the UK for the foreseeable future, giving the government a credit with the bankers at the Office of Budget Responsibility, allowing them to borrow more money on gilts to keep spending um, uh, without causing a crisis. Um, so by simply saying that if you've got a pension, you can no longer transfer that to be a taxable overseas, you're locking your pension payments into UK tax for the rest of your life. So that's your potential liability. For more information and guidance, contact us at ProACTPartnership.com to help you protect your pension while living and working abroad overseas. Will a pension's tax-free lump sum be attacked? Again, it's another scenario where they can play the long game or the short game. But if they remove the 25% tax-free lump sum, or they put a cap on the maximum amount you can draw as a tax-free lump sum, then this gives an option to the bankers that allows them to, in the Treasury, to have credit against future revenues that will come in. So if you said the maximum you can withdraw as a tax-free lump sum is set, say, the average salary of 40, 50,000. And if you want to draw more than that as a tax-free lump sum, it's income taxable. So that would mean that somebody with a £50,000 pension fund isn't going to be adversely affected, but somebody with a £1 million pension fund is potentially going to be locked into only getting 25, 50,000 as a tax-free lump sum, and the balance then is all subject to income tax. So you've got £1 million, 1% tax on £1 million is £10,000. So if you've got, you want to multiply the amount of tax you pay on that is your potential liability going forward. Reduce the tax-free lump sum, the balance of the pension fund is all taxable up to 45%. It's a real way to introduce a tax block to increase the tax take without charging anybody anything, other than people are getting future income and tax source when their UK pension provider pays that pension to them. They've done it with government service pensions already. Makes logical sense. Why not do it with a self-invested pension? Why give people the option to get to pay tax in a different country to lower rate when they could say, well, no, let's do what the Canadians and the Americans do and tax you at source on that pension fund because you've had tax relief all your working life while you're in the UK. So the rules today are what they are. The rules in the future might change. They might change on the 26th of November. For more help and guidance on protecting your pension, tax-free lump sums, income, and your property capital and your investment capital gains from future tax in the UK by using a family trust or business trust, um, uh, either with you as an individual relocating overseas or just having your offshore trust to hold your assets. Be your own fund manager, protect your own wealth, take responsibility for that, and don't involve anybody else and allow them to take money from you. Contact us at ProACTPartnership.com. We offer a free review, advice and guidance for people living and working abroad, investing in the UK, expats in the UK, expats abroad, using Cyprus and international trust tax law to pay the right amount of tax in the right way under the current rules. Before the 26th of November, we can help you save tax under the current rules and then advise you after the 26th of November on whatever changes come up. I look forward to the budget. Stay in touch with us at the Living Working Abroad show. And as we get more detailed advice and information as we come nearer to the date and clearer what's going on. And as I say, contact us at ProACTPartnership.com for book a free review with a consultant when you're ready before the budget. Thanks very much for listening, and we'll see you again next time.